Ladies and gentlemen, good day and welcome to the Q2 FY24 earnings conference call of the Anup Engineering Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. Before we proceed to the call, let me remind you that the discussion may contain certain forward-looking statements that may involve known and or unknown risks, uncertainties and other factors. It must be viewed in conjunction with our business risk that could cause actual results, performance or achievements to differ significantly from what has been expressed or implied in such forward-looking statements. Please note that the company have uploaded the results, press release, investor presentation, and also the outcome of the board meeting on the website of stock exchanges and the website of the company. I now hand the conference over to Mr. Nilesh Haripara. Thank you, and over to you, sir.
Good evening to everyone. This is Nilesh, CFO at Anup, and we have our CEO, Reginaldo D'Souza, on the call with us. We have clocked the revenue of 139.8 crore and EBITDA of 31.4 crore in this quarter, which is 22.4% of revenue. Retail helped us in clocking revenue of 265 crore and EBITDA of 59.4 crore in H1. State remains at 21.7 crore, that is 15.5% of revenue in Q2, whereas in H1, PAT is at 40.30 crore, which translates to 15.2% of revenue. It gives us immense pleasure to inform you that on H1 current year versus H1 last year, revenue from the operation has grown by 73%, EBITDA has almost doubled, and PAT has increased by 122%. Our ROCE for the quarter is at 23.6%, whereas return on equity is at 18.9%. On the balance sheet front, net cash is 59.50 crore, which is net of debt of 45 crores. Working capital terms achieved during Q2 is 3.5 terms, mainly on account of reduction in the receivable and higher receipt of advance from the customers. With this update, I would like to hand over call to our CEO, Mr. Reginaldo D'Souza, to give you update on the operations and market before we open up a session for the question and answer.
Hello, a very good evening and a good day to all, and warm greetings from Team Anup. We are glad to be part of this call to present our quarter 2 results and overall performance. I must say the team at Anup has executed the plan very well so far into this year to ensure we post a good performance in Q2 and H1. So my sincere thanks to all our dedicated and committed team members, our partners, our suppliers, and all our shareholders for standing by us and trusting the brand Anup. So let me take you all through the performance into Q2 and H1. So on the revenue front for H1, as mentioned by Nilesh, we have posted a 73% growth to clock a revenue of 265 crores INR with a decent EBITDA of 22.4% at 59.4 crores INR, which is almost double of last year during the same period. Also, as mentioned by Nilesh, all the other parameters on working capital, cash flow, and financial ratios have been very encouraging in quarter 2 and H1. On the industry that we served in Q2, oil and gas and petrochemicals still holds the dominant position at 82% of our revenue. Fertilizers came in second at 17%, which also includes our business for hydrogen projects. On the product portfolio side, Heat exchangers still maintains the dominant position at 76%, and reactors, vessels, and columns at about 21%. Now, as I mentioned earlier, also in the last call, this will see a change as we move ahead in time, as our KEDA plant starts dispatching equipment, because strategically, KEDA will be manufacturing all vessels, reactors, and columns. So obviously, we see this percentage mix changing, and vessels and reactors taking a little higher percentage as we grow and move in time. Exports, which is another strategic focus for us, at the level of H1, it stood at 15% of our total revenue, and as guided earlier, we should touch an exports revenue of approximately 30% in this financial year. This is based on the order booking in hand and our dispatch plan for into quarter 3 and quarter 4. So we should be comfortably at about 30% exports of the revenue for the year. On the order booking side, I must say we had a very good run. At the end of Q2, we had a total of approximately 355 crores worth new orders booked in this financial year, which translates into a pending order book of 630 crores as on H1. Carrying on with this momentum, this month, I must say, has been an outstanding month for us. That is the month of October. We booked about 243 crores worth of new orders this month, 243 crores. This is historic and the highest ever that we booked in a month. So as we speak now, we have clocked approximately 598 crores worth new order booking in this financial year so far, and interestingly, 55% of them for exports. So this is another important factor of this new order booking. And also, I must say, a good portion of it is booked for hydrogen projects. So this signifies our presence on the journey towards energy transition and a hydrogen economy across global projects. So this new order intake means a pending order book of 873 crores as on date. This is the best we ever had. So 873 crores as on date as we speak. So considering our plan for this financial year, and if we put the numbers together, as on today, we would have approximately about 590 crores of orders to be executed in the next financial year, FY25. And we are still counting, as we have some good prospects in the coming months. This means well for us and perfectly in line with our growth plan of 25 to 30% in the coming year. On our new manufacturing facility at KEDA, I am happy to state that we have dispatched our first equipment from the plant in Q2 as planned and on time. So it was a large piece of equipment weighing about 200 metric tons for an export order for a customer in Jordan. So KEDA now with this moves full steam executing orders for the coming quarters. And I'm also happy to state that good part is that we have over 100 crores order already booked for the KEDA plant. So that means well for this new facility which we commissioned and inaugurated in the month of June. I'm also happy to announce that we have expedited the decision on adding capacity at KEDA. We have decided to extend one partial bay which was built in phase 1. So we are going to complete that bay. So if you remember, we had built 1.5 bay, manufacturing bay, of the total 7 bays that we had planned at the macro level. So that 1.5 bay, we are going to now complete that half portion and complete 2 full manufacturing bays. The plan is to make this operational in early Q1 of FY25. So by March, April is where we are going to complete the construction phase and start and commission this extension of the existing half-way. This means we will have 2 full manufacturing bays as against 1.5 for the next year. So this will need an investment of approximately 15 crores, and we have a plan to complete it within next 5 to max of 6 months. We are also making some good moves on sustainability initiatives. We have started on the project of rooftop solar at our Odor plant. With the commissioning of this plant, about 50% of our power utilized will be from renewable source. This would be a good move, and we will continue on this journey of getting our power utilized from renewable sources. Also at Kheda, since we have a vast land at Kheda, we have started a forestation project at Kheda in the open land available to create a green belt in a quest to offset our carbon footprint and contribute towards our sustainability initiatives. So all in all, to conclude, we had a very fruitful first half of the year, and the momentum created with a good order book position means well for achieving the growth plan of 25 to 30% for this year, that is FY24, and also sets the stage for a similar growth in the next financial year, that is FY25. Having said this, we are also aware and cautious of the current geopolitical uncertainties, elevated oil prices, and also volatile economic outlooks in various parts of the world. But I'm confident that with a good business visibility into the next year, on account of a strong order book and order pipeline already on hand, and at the strength of a strong execution team at Anup, and with the support of our reliable partners and suppliers, we will be able to deliver on plan. So with this, I end my remarks and comments on the performance of Q1 and H1, and we would be happy to open up the session for Q&A.
Thank you so much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abhishek.
There are more than 20 parties in the conference.
Hello?
Yes.
Sorry, your line went into mute, hold, I guess. So the first question we have is from the line of Abhishek Agrawal from Naredi Investments. Please go ahead.
Yeah, am I audible?
Yes, sir.
Yeah. Good evening, sir. And
there are more than 20 parties in the conference.
Congrats on the good set of numbers. Sir, I have 2 questions. First question, what is the reason for lower the cost of employees and other expense in Q2 compared to Q1 FY24?
So as we speak in the Q1 call, there were certain variable incentive portion of last year which were taken as a provision in the last quarter, And from this year, we have made a policy wherein the variable pay likely to be paid at the end of the year will be provided in each of these 4 quarters. So that one-time hit which we took last year, that is the reason why employee cost was higher. And the main reason for the reduction in other expenses is the royalty. In the last quarter, there were certain dispatches which were subject to royalty, whereas in this quarter, the dispatches which are subject to royalty is very minimum. That is the reason why there is a reduction in the other expense in this quarter. Nonetheless, we would like to tell you that the royalty which we are supposed to pay on the product is already built in the cost, so it doesn't impact our profit beyond the point.
So yearly basis, what should be the other expense?
Just a moment, huh? Can you repeat your question?
So yearly basis, what should be the total other expense in FY24?
This would be in the line of Q2 only.
Okay. And second question, this enhanced net profit margin you attained in Q2 and H1 FY24 is sustainable, and this kind of 15% net profit margin will be maintained for next 2 to 3 years?
Yes. Yeah.
Okay. Thank you so much.
Thank you so much. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Abhineet Anand from 3P Investment. Please go ahead.
Yeah, just wanted to understand our role in the hydrogen part that you were talking about, that some of the orders that you got in the international market is, so what exactly are our roles in this hydrogen part?
Yeah, so hydrogen, as we know, it broadly has 3 aspects. One is the generation side, one is storage and transmission. When we speak about, say, for example, green hydrogen, on the generation side, we do not have any role per se right now because that's more on the electrolyzers and generation using green electrolysis process. Where we play a role is in storage and transmission of this hydrogen. So today, we are manufacturers of static process equipment, and those are the equipment that are used for storage and transmission of hydrogen. So broadly, even today with our capabilities and capacities in place, we are able to serve customers for hydrogen business, and we will continue to do so in the future. So broadly, a direct answer to your question, it's more about storage and transmission using static process equipment that we build. So it's not a different product portfolio for us. It falls in the existing product portfolio bucket.
Okay. And I mean, is it possible to state, like, for example, over the next few years, how important can this segment be? Like, let's assume today we are at X%, which might be small because it is initial time. Let's say, and over the next 3 to 5 years, can this become a significant opportunity for us?
Yes, surely it's already becoming a significant opportunity. So as I mentioned, the current order booking that we had, a substantial portion of it has come from hydrogen projects for exports, largely in places like Louisiana, USA, and Canada. So we see a lot of hydrogen projects. Of course, we don't see as many green hydrogen projects, but the blue hydrogen, which is probably the intermediate stage, till such time that green hydrogen really picks up. Because I think on the green hydrogen side, the cost would be a major factor. Today we see anywhere based on the information available, the cost is anywhere, the price is anywhere between $6 to $7 a unit. And what it will make affordable and a mass demand would be somewhere around $1.5 to $2. So that would take some years, but I'm sure intermediate till we reach that stage, blue hydrogen will be the path forward, and a substantial portion of it is coming from hydrogen projects for us today.
And any green shoots you have seen on this side in India, sir?
You mean to say on the hydrogen projects?
Yeah.
Yeah, so there are a couple of projects which are being initiated. Of course, it's not at the same scale as we see abroad, but there are pilot projects which have been announced, and we see this taking and picking up in the near future. From our perspective, from the Anup perspective, we are ready. It's the same product portfolio, so it's just about getting the inquiries, quoting, and winning the projects and executing.
Thanks, sir. Those are my questions.
Thank you so much.
Thank you.
There are more than 20 parties in the conference.
Ladies and gentlemen, just a reminder, before we take the next question, you may press star and 1 to ask a question. The next question is from the line of Bharat Gupta from Fair Value Caps. Please go ahead.
Thank you, sir. Congratulations for a good set of numbers. Sir, a couple of questions from my side. So when I look at the overall space in terms of the capex intensity which lies in the domestic space, so definitely there has been some sort of a slowdown if I look at the chemical space alone. So how do you rate? Because I believe 4,000 odd crores of bid comes on an annualized basis. So are we seeing that kind of a slowdown getting impacted to us in a way in the domestic space?
Yeah. So on the domestic side, yes. On the refining and petrochemical side, we are not seeing the same drive as we saw last year, because there are some projects which have been announced and yet to take shape, but they are in the preliminary stage of getting along with the project. What we see is a lot of projects which are coming up on the petrochemical side, and also especially in PVC, polysilicon, and PTA plants. So there are a lot of projects on the cards now, and if you remember me talking about why do we want to have the geographical spread to be focused on exports as well. This was the precise reason, because we have seen this nature of capex is cyclical. Of course, we are in the best capex cycle right now, and a stretched one too. But it is going to be cyclical in nature, and that is the reason the geographical spread is extremely important, so that it does not impact our business going forward. And that's where we have a good mix now of domestic and exports, and that would protect the growth going forward.
Right, sir. Sir, just on the export bit, because I believe our strike rate in the domestic space is near about 30%. So how are we placed in terms of the export orders which we get? What would be a strike rate in that?
Strike rate in a sense, you mean conversion order conversion rate?
Right.
Yeah.
Right. Conversion rate.
So we are in the region of 15 to 20% average strike rate, and we wish to keep it at that. As I mentioned earlier too, it is all a factor of the profitability that you want. You can improve your strike rate by taking orders at a lower margin, which is not the strategic intent that we have. So based on the experience and based on the inquiry bank on the table today and what we see in years down the line, we feel 15 to 20% conversion rate is a good strike rate for us to maintain growth as well as profitability.
So, sir, in a way, if I look like overall in terms of the margins, EBITDA per ton, so that will be comparable to the one which we enjoy in the domestic market?
Exports will be comparable. In a sense, when we book the orders, we don't see much of a difference in the margin profile. But yes, exports do benefit us from the perspective of better working capital, because the advances are much better as compared to domestic orders. And also, more than often, we are conservative on the forex side. So when we actually dispatch and get our monies, we tend to benefit out there. So like to like at the order booking stage, there would not be a substantial difference. But once you kick into execution, export orders do help us as compared.
Right. And so when last time when we were discussing, so probably we were thinking of adding new like titanium kind of a coating, so that gives you a edge in terms of your protecting the margin side, because we are fairly about 20-odd%. So in a way, going forward, do we think that because hydrogen would be one which will be constituting a major part of revenues going forward, so there the margins will be remaining on a similar sort of a trend, and it will be more of a premiumized kind of a segment for us?
Yeah. So as I mentioned, our strategic intent is as we grow to maintain a 20% plus kind of an EBITDA range. That's what our intent is. So it is all about making choices. And currently also the orders that we are booking in the hydrogen space and elsewhere, we are choosing products, or in other words, we are going aggressive on products and orders where we get a better product mix in terms of higher metallurgy. So with for the same kind of churn and execution on the shop floor, we tend to get a higher realization in terms of revenue and EBITDA. When I say EBITDA, it's an absolute EBITDA from executing projects with higher metallurgy. So we see that trend going, and that is clearly a differentiating factor for us going forward, because labor arbitrage will not work for too long. So we have to differentiate ourselves and create our own USPs by having more fast track records on executing critical projects. So we will be strategically going more deeper and more wider into the product segments.
Right, sir. And just a last bit, what will be a timeline for the execution of the current orders which we have received over the last 6 months? And we aspire to become a 1,000 crore top line company. So do we is that 25% kind of a CAGR growth is sustainable over the next 3 to 4 years?
Yeah. So the answer to your first question, as we speak, all the orders that we have booked is within the realm of FY25. So we've got deliveries until 17 to 18 months. So it falls exactly into the end of FY25. So whatever order book that I mentioned will all be executable by the end of FY25. Second question. Sorry, what was the follow-on question on that?
So just wanted to check, like, in terms of our aspiration to be a 1,000 crore company, in terms of the top line, so are we, like, do we see the momentum to remain on a positive side? We want to grow at 25% CAGR over the next 3 to 5 years?
Yeah. So our growth guidance remains the same, that we want to grow at a 25 to 30% growth rate. And as I mentioned, on the order booking this year has been quite encouraging, and we see this momentum going forward with right choices made from our side.
Right. Sir, just one question, particularly just a follow-up on the export bit. Given out the competitive intensity, so like what remains a key moat out there in the export side? Is it just primarily on the cost side, or is there something where we have the expertise in the product design? So what according to you has been the key moat and the key reason why we have been able to receive a good order from the export side?
Okay, so the primary requirement in export, of course, we being supplying equipment which are customized and high on technical nature, getting qualified technically, of course, is the primary requirement. But assuming that the competitors are all qualified and capable of getting the bids and quoting for it. Next, of course, price is a determining factor today because budget is a big constraint. But having said that, I think what we are seeing in export is also more on reliability and a good experience in terms of the way companies do business. So we've seen many repeat customers coming to us just because they had a very good experience working with us, especially on the way we execute projects on time, and of course without saying quality is a hygiene for them. So largely on price, yes, that's a critical factor. But added to that, I think good past experience and reliability in terms of supplying equipment on time is a critical factor. Because as we said, our products would be a few crores, but the customer's projects would be $1 billion. So a lot depends on our timely delivery of equipment. And I think that's the USP that Anup has today.
Right. Thank you so much. Thanks for answering all the questions.
Thank you. Our pleasure.
Thank you so much. The next question is from the line of Nitin Gandhi from InnoQuest Advisors Private Limited. Please go ahead.
Yeah, thank you very much for taking my question. I just wish to understand the dynamics of adding bay. I rather appreciate the decision to have half bay quickly, but how is it linked? What kind of volume or what kind of revenue order book flow will force for addition of next bay, and how does it change cost-wise? And I have one follow-up question thereafter. Thank you.
Yeah, hi Nitin, thanks for the question. So if you have heard us even in the last call, I think we had a lot of interactions on when phase 2 at Cheda, after we came up with phase 1. So phase 2 is 2 bays which we are going to add. So intermediate to that, since the order booking has been really good, the market dynamics are favoring us. What we felt is that the extension of that half bay gives us that added capacity to delay that phase 2 a little bit, depending on how the market moves. So considering the order input, a good visibility in terms of, as I mentioned, 100 crore plus for Cheda already and counting. We see a lot of inquiries for vessels and reactors on the table. So we foresee that at Cheda we may quickly be out of steam in terms of capacity, and we don't want to reach a position where we have the business opportunity and are not able to execute. And that's the reason we took a call, and it's not much of an investment for us. It is just about 15 crores kind of an investment, because we had already done half of the construction work in the first phase. Like all the piles for foundations were already erected, the floor was already ready. So it's just a question of covering the shade and having the final RCC flooring. So that's the reason we took that call. Number one, it will be quick, 5 to 6 months project. So we will be having the shed up and running by March to April. And also the investment was not too heavy for us. So that gives us flexibility in terms of added capacity.
No, so I was just looking forward to say the subsequent phase. Can we say that every 300 crore order book addition will seek additional bay, and maybe the investment will be somewhere around 35-40 crores? So because we have the capacity for 7 bay, so I'm just trying to understand that logic.
Okay. So yes, so we have the overall master plan of 7 bays. So as I said earlier, each bay would cost us anywhere between around 40 to 50 crore kind of an investment. And each bay can give us a revenue, depending on the product mixes, around 150 crore. So as we move ahead in time, and we need about 12 months for every bay to be constructed. So as we move, the right timing for us for phase 2 with this extension would be in FY25. So as we approach and get into FY25, based on the order booking and the future forecast, we will take a call on phase 2.
Thank you very much. I have another question is, how do we see what is our role, you say, in static process equipment for hydrogen plant, but what kind of revenue for some X capacity of hydrogen is possible for us based on the competition profile? Because that segment data is there that the blue hydrogen is getting added so much. But what will be our revenue from each of hydrogen, say 100-ton plant or something like that? If you some indicator, if you can share that, how do we correlate our revenue with whatever blue hydrogen expansions are happening?
Yeah, so every hydrogen plant, depending on the licensor involved, will have different kind of configurations. So we'll not be able to peg the same numbers for all kind of configurations. But roughly, of course, these data points are not available, but based on our own experience, for a project of a particular size, roughly about 2.5% to 3% is the static equipment requirement, where we at Anup will be able to bid for. Now, when I say this 2.5-3%, it is a product portfolio that Anup is interested in. Of course, there will be a lot of other projects on the lower segment or low thicknesses where we may not be interested, and also on the much higher segment where we are yet not qualified and we wish to get qualified in the future. So on an average of this is around 2.5 to 3% is a kind of static process equipment requirement based on the size of the project. Now, for example, a project could be, say, for example, $2 billion kind of an investment, depending on the size that they build. We could have an opportunity of about 2.5% in static equipment. Of course, those are the inquiries that we can bid for. Then, depending on the win rate and how competitive we are, the order booking will be commensurate to that.
And the last question. So you said that at this juncture we have some capability and we aspire to go to higher level. So in terms of supplying the SP, so what could that be? Will that change the percentage 2.5, 3 for Anup to say 5-7%?
So that moment or that strategic moment is basically to stay relevant and to be up on the competition bracket. So as I said, there would be a lot of smaller players emerging in this market, and rightfully so, because the CapEx cycle is so good. So for us to stay relevant, we will have to keep moving up in terms of complexity of the equipment, both in terms of metallurgies and in terms of the equipment complexity. So that's more to staying relevant and getting the order book position growing as we grow into the future.
Thank you. Thank you very much, and wish you all the best for hitting 1,000 crore soon.
Thank you so much.
Thank you so much. Ladies and gentlemen, a reminder to all the participants, you may press star and 1 to ask a question. Also, and to ensure that the management will be able to address a question from all the participants in this conference, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. The next question is from the line of Abhishek Poddar from HDFC Mutual Fund. Please go ahead.
Thank you for taking my question. So congratulations on a very good set of results. So first question is regarding the inquiry pipeline. If you could give us some understanding what inquiry pipeline are looking for the rest of the year. You did mention about a 15 to 20% strike rate. And so second is, because of the addition of blue hydrogen static equipment, how much gets added to the inquiry pipeline on an annualized basis? If you can give some understanding there also.
Yeah, so overall, we as we speak, it's real time. We are at about 1,000 crore kind of an inquiry bank on the table. of which 600 to 700 comes from our conventional oil and gas and petrochemicals, and about 200 to 300 comes from hydrogen. Hydrogen means green, blue, all put together.
Right. So this 1,000 is for the rest of the year, sir?
It's a rolling. So month on month, new inquiries keep adding. The old ones keep getting finalized. So at any given point in time, as we speak today, we have 1,000 crore inquiry bank. And
there are more than 20 parties in the conference.
Few years that we have carried an inquiry on an average of 1,000 to 1,100 crores.
Okay. So given this is rolling, sir, if we have to understand it from the analyzed basis, that let's say for this full year, 12 months, so what kind of inquiry you would be responding to? Can you give some understanding, sir? It will help us little, to understand what success rates and all.
Yeah. So on an average, if you look at historical data points, we've been quoting to anywhere between, on an average, 4,000 crore kind of inquiry is where we've been quoting for. So as we grow, gradually we'll tap into more and more geographies. That's our intent because we are spreading out. So most likely we would be touching a 5,000 crore kind of inquiry bank.
Understood. And sir, out of this 5,000, you mentioned 20-30% is hydrogen. So about 1,500 will be hydrogen, and the 70 would be oil and gas.
Yeah, so that's what it looks like today because we are seeing a lot of projects being announced on hydrogen, especially in exports. Hopefully the trend continuing, we should see this kind of breakup.
Understood. And so what will be the breakup of this 5,000 in domestic and international?
Largely about 3,000, 2.5 to 3,000 is domestic and balance is exports.
Okay, understood. And so just one more question.
Having said this would change year on year because the investment obviously are cyclical in nature. But if you take averaged out, it would be around in that range.
Understood. And so this one more question on the 2 bays at Kheda. So if the half bay is also commissioned, what will be the total revenue that we can generate from Uddhav and 2 bays at Kheda?
So with Uddhav and 2 bays at Kheda, we should be comfortably at about 750 crores.
Okay. And the remaining 5 bays, how should we think about the decision to add those bays?
There are more than 20 parties in the conference.
Yeah. So the timing of the investment, how we have planned is, as I said, it takes about 12 months, 11 to 12 months to set the base. And good part is that we already set the utilities in place for the whole master plan. So what we need to add is only the manufacturing base. So we will time it with an understanding of about 12 months to set each base. And as we move, accordingly we'll time the investment.
Understood. And so how will be the total capex this year, including this 15 crores?
1 second, let me just see the number. It should be about 60 crores, including this 15.
Okay. And should this fall in 25, assuming this 15 crores is already spent?
You mean to say this capex will fall in FY25?
Yeah. So 25, yes, sir.
So part of it would be commissioned in this year, FY24, and part would go into FY25. 15 for sure will be commissioned in FY25. So we could roughly say about 20 to 23 crores in FY25 and balance in this. Yeah.
So overall capex number will be 60 in 24, and even in 25 it could be a similar number only.
That's correct. Largely, of course, there could be some sort of operational capex in terms of some small machinery addition, but largely, yes, around this number.
Okay, understood, sir. Thanks you, sir, and all the best.
Thank you so much.
Thank you. The next question is from the line of Alisha Mahavala from Envision Capital. Please go ahead.
Hi, sir. Good evening. Thank you for the opportunity. So first question is on gross margins. There's a decline sequentially and YOY. How should one understand this?
Yeah. So if you look at the numbers this year, the COGS in quarter 2 and H1 stands at 58. Now, what's happening is, as I explained in my last call as well, as we move up into more and more complex equipments and complex metallurgy, the component of material content would progressively go up. Just as an example, a carbon steel, say a simple carbon steel would have about 50% kind of a raw material content, whereas if you go for titanium and others, it could go even up to 70 and 80% kind of a material content. So as we move into more and more complex, the COGS would go up broadly because the absolute EBITDA will go up by we moving up the ladder in terms of complexity chain, but percentage-wise EBITDA is going to drop, and that's the reason we were saying in the last call that we will never see those historic like 29% and 25% kind of an EBITDA, because as we grow, our material content as a percentage of revenue would keep going up with the complexity of...
There are more than 20 parties in the conference.
Okay, so the 22% kind of margins that we've been doing since the last 2-3 quarters, are these more sustainable numbers?
Yeah, so we will strategically, that's the choice. So even on the order booking front, when we make choices, we are very sure that we are going to be around that number.
Sure. And with the mix of the order book skewing towards exports and, like you mentioned earlier, also, with KEDA skewing towards reactors and pressure vessels, with the new mix also, is the 22 sustainable, or was heat exchangers and especially on the domestic side slightly more profitable, and there can be a chipping off of margins from here also?
No, going forward it's sustainable, and that's the strategic intent we have going forward. So as I said, it's all about making choices. So that conversion or strike rate that we were talking about, 15-20% now, it can be taken to 25 and 30, and the number of order booking could go up, but then it would mean we would compromise on our margin. So that's the strategic intent, that we have to grow at 25-30% rate year on year, and also maintain 20+% kind of an EBITDA.
Okay. So just a clarification on this point. Generally, when we hear other players in the space speak, the more complex or more customized the product is, it helps us command a slightly more premium and hence, slightly better margins. For us, it is the other way around. While I do understand that raw material components will be higher, like you said, bigger sizes, more complex sizes, lesser people who can, manage to do it as efficiently as we can. Shouldn't that technically help us also enjoy better margins?
Yeah, so what happens is when we move to a particular product bracket, right, there would be a competition. Say, for example, 4 or 5 players who will play in those complex equipment. Now, the profit margin that we can enjoy, the contribution is on the value addition that we do. Say, for example, a titanium heat exchanger, which is high on raw material content, the value addition that you do in terms of conversion almost remains the same. So your absolute revenue goes up, your absolute EBITDA goes up, but when you look at the percentage EBITDA, it will be on the lower side because of the lower contribution margin that you get.
Okay, understood.
So moving up the metallurgy chain helps you to play with very few players. Say, for example, if you play in a normal carbon steel, you have...
There are more than 20 parties in the conference.
The moment you move into the niche segment, you would have 3 or 4 competitors to play with. So it helps you to better your win rate and also grow your revenue and EBITDA in absolute terms.
Got it. And so, as on October, the order book is at 872 crores. Can you give us the split between heat exchangers and reactor pressure vessels for this?
So, reactors and pressure vessels still stand at about 22%, and the balance is exchangers. So, heat exchangers still holds a dominant portion, but as we move now, because the order booking for KEDA is going to progress as we move ahead in time, we will see that portion going. So as I mentioned earlier, the peak that we see still is around 65 to 60% heat exchangers and 30 to 35% vessels and reactors. So heat exchangers will still be a dominant portion in our product portfolio.
Okay, great. Thank you so much.
Thank you.
Thank you so much. As there are no further questions, I would like to hand this conference over to Mr. Reginaldo D'Souza for the closing comments. Over to you, sir.
Thank you. Thank you for those questions. Very, very interesting and insightful for us. And thank you for your time. So I once again take this opportunity to thank each and every one who has contributed to this performance, and especially to all our stakeholders for your trust and standing by our side as always. So thank you, and on behalf of my team at Anup, I wish all of you a very happy festive season and a very happy Diwali in advance. Thank you so much and have a good day ahead. Thank you.
Thank you so much, sir. On behalf of the Anup Engineering Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you, everybody.